Buckle up, everyone. You are strapped in and ready for Insurance Hour with me, your host, Karl Susman. Informing, educating, and entertaining, one policy at a time. This is Insurance Hour. Hello. This is Insurance Hour with me, your host, Karl Susman. Thank you so much for being here today. We have an exciting show, and the show is all about you. This show is about you because these are going to be questions that you have submitted to me that I'm going to do my darndest to answer for you. Remember, you submit your questions by email to questions@insurancehour.com, or you can call me at 559-656-0317. You can also text that number as well. So once again, these are your questions, not mine. So you know what they say? There's no such thing as a stupid question. Yeah, that's not true. There is. No, I'm kidding. Ask them away, and I'm going to go through and read these. We've got a stack of them that I've been saving up for just such an occasion. So let's jump right in, okay? First one says, "Hi there. My homeowner's premium jumped a lot this year with no claims. Can you help me understand the most common reasons carriers raise rates in California and whether shopping around actually works right now? I'm in a normal suburban area, not a canyon or anything like that." Well, California, as you probably know, and if you don't, you'll certainly know by the end of this show, has been really in a tough place when it comes to property insurance for quite some time right now, because of issues having to do with regulations as well as natural disasters that have been happening. We have had the market basically implode. There have been carriers that are not offering coverage. There have been carriers that have been offering coverage on a limited basis. It's been tough. It's just been really tough. So to answer your question right now, it's not necessarily the best time to shop, right? Now, I'm not saying you shouldn't. I'm just saying that the likelihood is you might not be able to save any real money if you do so, or you might end up with a carrier that you've never heard of before, and you're not going to be saving anything significant, right? So, again, I would like to be able to say, yes, shop. It's always the best thing to do. But unfortunately, right now, that might not be the case. Soon, sometime in the next, I would say at some point in 2026 here, we'll be able to start seeing competition come back to a level where it makes sense to shop. But right now, what you want to focus on is doing things to make your home less likely to have a loss, because that is going to be the best way for you to save money on your insurance policy. What that means is you want to do things, it's called home hardening, for example, right? Home hardening. This is doing things that will make the house less likely to catch fire, for example. It might be changing the type of roof you have. It might be being sure that there are no trees overhanging your home, things like that. I want to say obvious things. They're not obvious to everybody, but things like that. And you're going to be hearing a lot more about that as time goes on, because doing things to save money on your insurance is going to be a lot more in your hands than it ever has been. In the past, it used to be where you could, shop around for a policy, and you might get one policy for $1,000, one might show at $700, one might be at $1,500, all over the place. And it wouldn't really make a difference what the situation was with your home in particular. That is not going to be the case much longer. What you're going to start seeing is you're going to start seeing your premium more heavily impacted specifically by the things that you do to your home. So stand by for that. That's, by the way, thanks to some guidelines that have changed in the state. The insurance carriers must, M-U-S-T, capital, take into account things that you are doing to make your home less likely to burn. And they have to offer significant discounts for you as well. So there's your answer, and that's regardless of if you're in a suburban area or a canyon or anything else like that. Let's get on to the next question. I'm buying my first house, and the lender says I need a replacement cost coverage. What's the difference between replacement cost coverage and what I'm paying for the house? I don't understand what this means if there's a fire. Okay, that's a great question, and it's misunderstood quite a bit, so I'm going to take a little bit of time to really try and go over this with you. Now, what it costs to rebuild your house has to do with the replacement cost. What does it cost to replace it, to rebuild it? Now, the market value can fluctuate. right? You've heard of the property values for homes going up, going down. Depending on where the property is, it might be worth more, it might be worth less. If you're looking at, let's just say, a small home and it has a gorgeous view, that might cost more to buy the entire house, the market value per se, than that same size house that might be just in the middle of the city. So the market value and the replacement cost value, while there could be some correlation, they are definitely not the same thing. Now, your lender is only interested in one thing. Your lender is going to be interested in having protection for the house. They want to be sure that the home can be rebuilt in the event of a loss. Remember, your home is their collateral. They're giving you money, in California, a lot of money, to be able to buy this house. And they want to be sure that if there's a loss, there's an insurance policy to be able to get that home back, because that's the only thing standing between you making those payments back to them that they loaned you for that money and them being able to, in essence, take over the house to sell it and try and get their money back. So make sure that your home is insured to replacement cost. Again, don't look at the market value. Find out what it costs to actually rebuild. Now, that's, again, a loaded question, because how do you determine that? Lots of ways. You can do everything from work with your insurance company, agent, or broker. Look at some of those cost estimating programs that they have. You can talk to local contractors. You can talk to local architects. You can talk to local real estate professionals. There is no one size fits all. There is no way to get that exact number perfect every time. And we learned that in some of the more recent fires of 2025. What it might cost to rebuild your home if it burns down only is significantly less than if the whole city burns down. Because if the entire city burns down, then now you're looking at price surges, because you're going to have a lack of availability because everybody's trying to rebuild, right? So that's going to impact what it costs to rebuild your house. Lots of factors to go through, lots of things to pay attention to when you're going about determining the replacement cost value for your home. Understand, this is something that consumers need to take very seriously. Don't just assume that the first number that's tossed out might be the correct number, right? And again, going between different brokers, some brokers use different tools, some insurance companies use different estimators. You want to do everything you can to try and get the most accurate number. And I want to get you the most accurate information, which I will continue to do right after the break. Again, this is Insurance Hour. I am Karl Susman. Let's take a quick 60-second break. We'll be right back with your questions. This is Insurance Hour.
Insurance Consumer Guidance Society, ICGS. Independent, accessible, empowering. Educating Californians for smarter insurance choices. The Insurance Consumer Guidance Society, ICGS, is a 501c3 nonprofit organization dedicated to providing the residents of California with clear, unbiased educational resources about insurance. Our mission is to enhance consumer understanding of insurance products and the evolving regulatory environment, particularly in light of challenges posed by climate change and market shifts. ICGS provides comprehensive insurance education, public and media outreach, and direct consumer support. ICGS serves the public by fostering informed decision-making in a dynamic insurance landscape and empowers Californians with the knowledge they need to confidently navigate their insurance choices. To learn more about how we can serve you and find free resources, visit us online at icgs.org.
Hello. This is Insurance Hour with me, your host, Karl Susman. Thank you so much for being here today, talking and learning about my favorite topic and yours, insurance. Remember, this show could not happen without the generous support of the Insurance Consumer Guidance Society. They are a nonprofit, and their sole mission is to help you understand and properly utilize your insurance policies. More information available at icgs.org. Thank you so much again to the people over at ICGS for being there and being sure that we stay on the air, providing this important information to the people of California. Let's jump back in. We are taking your questions today that have been sent in. These are all emailed questions that I'm going through. The next one says, our policy says we have a 2% wind hail deductible. Is that 2% of the claim or 2% of the dwelling limit? I'm confused about what I'd actually pay out of pocket after a storm. That's a great question. And what's interesting is we didn't used to see a lot of percentage discounts out there. It used to be that you would see a dollar amount and that would be your deductible. But as time has gone by and more products have come out and people have tried to find ways to save money on insurance, the industry has responded and come up with more ways to modify deductibles, basically make them larger. Now, when you're looking at a percentage deductible, typically, and I'll say typically because policies can be different, it will be based on the amount of insurance that it's covering. So, for example, if there's coverage for a structure and the dwelling limit, and there's a percentage deductible of the dwelling limit, then you're going to be paying the percentage off of that dwelling limit. Right? So it has nothing to do with how much damage there actually is. It's going to be that a fixed dollar amount of that dwelling limit. Now, that means you actually can very easily figure out what that deductible is going to be by multiplying the percentage by the amount of coverage. Why they don't just list it that way, I don't know. I think that would make things a lot easier. It certainly would have made your life easier and you wouldn't have been confused, but I am not an insurer. What can I tell you? I'm a lowly insurance broker that does nothing other than try to educate the masses on the joy of the industry that I work in. But at any rate, to answer your question, short and simple, the percentage is going to be of the amount of coverage you have that is being provided for and not the amount of the loss you're having. Great question. Thank you for that. Next one says, we rent out our home on Airbnb a few weekends a month. Does regular homeowners insurance cover that, or do I need something different? It's a great question. It's amazing how you watch things change over time. There was a time, and it wasn't that long ago, where the concept of renting out your house to strangers was inconceivable. You just wouldn't do that. Sure, some houses you would buy and you would rent them, or you'd own an apartment building, you'd rent that out. But the idea that the actual home you live in, you might rent out, who would do that? It wasn't even a thought on anyone's mind. Now, short-term rentals are another issue because, again, when you're talking about an Airbnb, this is not a 6-month lease or a 12-month lease. So not only are you looking at people potentially renting your property, but they're renting it for a short period of time. This is a very different exposure than someone who has signed a 1-year lease, for example. So to answer your question, if you are renting out any property that you own, whether it be your primary home or another location that you own specifically for the purpose of short-term rentals like Airbnb and VRBO and all of those other companies, you absolutely need to obtain special insurance to do that. Your homeowner's insurance policy does not automatically have coverage for that type of exposure. And that makes sense because, as you can imagine, what do you think is more likely to have a loss? A home where the homeowner is living there all the time, or a home where different people that don't own the home rent for a couple of days and leave, and rent for a couple of days and leave, and another group of people come? It's a totally different exposure. Now, some insurance companies will allow you to modify your homeowner's policy by endorsement, which is just a fancy word for a change to the existing policy. They'll let you modify it and allow you to have short-term rentals included. Some insurance companies will make you purchase a separate policy altogether, and some will just say, not doing it. We're not in that game. So make sure you find out. Don't assume you have coverage and then have a loss and then realize you don't. I know sometimes you feel like it's just better not to ask, don't tell. And then, you can just, throw your hands up and say, well, I thought I had coverage. Doesn't work. If the policy doesn't provide coverage, then not knowing is not going to make coverage appear later. I know it's a little bit cold, but that's the way it works. A couple more. Let's get in before our next breather. Next question says, I've heard building code or ordinance law, I think they mean ordinance or building codes, matters in older homes. What does it pay for? This is a great question. Now, remember the concept of insurance, the general overarching concept is what was there before is put back again, right? You're not going to have anything better or worse, even though it's kind of hard not to end up with something better because you're getting something newer, but you know how that goes. So if you have a house that's built in the 50s, actually this email says their house is built in the 50s, and it burns to the ground, you can't rebuild a house to the 1950 code. You have to build it to the building codes that exist today. And you can imagine they're going to be significantly different today than they were in the 1950s. Right, but didn't I just get through saying that homeowners policies are designed to put back what was there, put back the same thing that you had before, not to make you better off? Well, building code upgrades or ordinance and law, it has several different names and they have some subtleties that make them different, is going to pay a specific amount that is in addition to what it costs to rebuild your home to be able to bring it to today's code. Let me try that again in a shorter fashion. Building code upgrades or ordinance and law is typically going to pay that additional money you need to bring your home to today's code. Now, if your house was built before codes have changed, which would be really sad, that say that your home is only a year old, there haven't been any code changes, then you probably wouldn't have much use for that particular coverage. But for the most part, when you're having a loss, you're going to be in a situation where when they need to rebuild, they are going to have to do things above and beyond what was there before to bring your house to code. So building code upgrades is a very important coverage to have. Some companies will include a percentage of that dwelling amount automatically. So they'll give you, let's say, 10% additional coverage for building code upgrades, and they'll allow you to purchase more if you like. I've seen policies go to 25%, 30%. I think I've even seen one or two policies that have gone higher than that. It can definitely make a huge difference in the event of a loss. So pay attention to that. Look for it on your policy. Talk to your agent or broker or insurer and be sure that you do have that coverage because it's a doozy. It will come back to haunt you if you don't have it and you need it. All right, listen, 60 seconds. We'll take another quick break and we'll be back. This is Insurance Hour. I am Karl Susman. Stand by.
Insurance Consumer Guidance Society. Our mission is to enhance consumer understanding of insurance products and the regulatory landscape in which they operate, particularly in light of mounting challenges that many consumers have faced, such as natural disasters and significant market shifts. These factors have contributed to an increasingly volatile insurance marketplace across California. ICGS is there to help. Please visit our website, icgs.org, and help support the nonprofit that's there to support you. Through education, engagement, and direct support, the Insurance Consumer Guidance Society strives to be a steadfast ally and resource for California consumers today and in the future. Visit our website now to support us at icgs.org. Once again, our website is icgs.org. Insurance Consumer Guidance Society. Educating Californians for smarter insurance choices.
Hello. This is Insurance Hour with me, your host, Karl Susman, the host with the most. Oh, wow, that's a horrible reference to an old TV show. I just aged myself about 30 years. Oh, anyway, we are here talking about insurance matters. And again, I want to thank the generous support of the Insurance Consumer Guidance Society, ICGS. They are the ones that are sponsoring today's show. We would not be here if it were not for them. Their sole purpose is to be sure that you understand your insurance policy, make the right decisions. They are a free resource. Visit them at icgs.org. We are going through your questions today. You know, you send those questions in to questions@insurancehour.com. You might be wondering, do they actually look at them? Does anybody really care? Yes, of course we do. I save them up for these shows when I can just go through and rattle off all the questions and answers. And I do the best I can to give you the correct answers. We'll talk a little bit more about that later as well. Let's jump back in. This question says, if a tree falls on my roof during a storm, is that covered even if it was an old tree? Also, who pays for removing the tree, me or the insurance company? Well, of course, that just brings the old joke. You know, if a tree falls in the woods and nobody hears it, did it make a noise? And all of the other permutations of that saying and that joke. But let's go through this. If a tree falls on your roof during a storm, and again, we're talking typically, right? There are always potential exclusions that could happen. Then yes, that would be something that would be covered under the average homeowner's insurance policy. Now, yes, they're going to pay to remove it. They're going to pay for the damage it caused, and they're going to try and pay to be able to get you back your house back into the situation it was in before. Now, the reason that I'm not so quick to just say, of course, yes, they're going to pay for all of it, is because I have seen situations where there have been trees, large trees, that have been looming over homes. The insurance company has come out, done inspections, and said that tree needs to be cut back. And the insured, the client, refused to do it. They said, no, it's special tree. It's been there for 100 years, and I'm not going to do it. It's not, blah, blah, blah. And then you can figure out the rest. So there are potential rubs that come in with this. Again, we're going to have to really start paying attention to doing things to protect our properties from losses more than we used to before. You can't be in a situation where you see something, you know that there's a significant potential for a loss, and you just opt to not fix it because, well, you've got an insurance policy. You don't want to do that. That's not going to be good for you in the short term. It's definitely not going to be good for you in the long term. And overall, it's going to hurt everybody in the long term, because when claims get put in that could have been avoided, that impacts everybody. All right, let's go on to the next one. We have a small kitchen fire. We had a small kitchen fire and smoke got everywhere, but the flames were put out fast. Is smoke damage treated like a fire claim? Oh, boy. Oh, boy. The reason I'm oh-boying is because smoke damage is, how shall I say, a thing right now, specifically in California from the wildfires of 2025. So let's talk a little bit about it. Now, damage by smoke, there's no question, can be horrific, and it can cost a ton of money, and it can cost money to get the air tested, and it can cost money to get it cleaned, and it can cost money to replace things. So smoke damage, there's a specific definition in every insurance policy that talks about what is smoke damage, what is covered, and what is not. And it can be very nuanced. The California Department of Insurance does have guidelines that the insurance companies need to follow, and they all do, except for one organization who I will not call out right now. Let's just say you're there because you have nowhere else to go. They do not seem to be following those guidelines, and we can talk about that at a later point. But smoke damage is something that is typically going to be covered under a homeowner's policy. Now, what exactly does that mean? Well, some definitions will simply talk about the damage that the smoke causes, and some, although they're not supposed to, will say there has to be permanent damage to something based on the smoke. So, for example, if you've got a pillow that's covered with ash, one policy might say, well, you can clean the pillow and all is good. Another one might say, well, if you can't clean the pillow, then we'll replace the pillow. Meaning, does it have to be permanent physical damage? So again, it's far beyond the scope of this program for me to get into the nuances of smoke damage, other than to tell you that it's a nightmare right now. And I am very hopeful that the Department of Insurance will enforce the guidelines that I know the insurance carriers are actually following for the industry, and the small few people that are not will actually, let's just say, be brought up to speed and play fair. Also, the Department of Insurance did put together a task force to discuss this very issue, because there was confusion and there was a lack of consistency for how smoke damage claims were being covered. That's a big one. Again, when you're talking about smoke damage, it's not just, oh, you go back to your house and it smells a little bit and you turn the air on, you open the windows and all is well. That's not what we're talking about. We are talking about the kind of smoke damage, maybe you could even call it ash, smoke and ash and chemicals. If you've got a fire that's nearby, and again, we saw a lot of this in the fires of 2025, when you are seeing lots of fire nearby, and sometimes not even as nearby as you might think, ash and soot and smoke and chemicals and you name it comes into your home. So it's not always that cut and dry to be able to figure out exactly what's damaged, how damaged is it, can we clean it, can we replace it, is it safe to clean it versus replace it? There's a lot of nuance that goes in here. My best advice for you when it comes to smoke damage, take a breath, take your time, and talk with experts. Because, again, you have a policy, an insurance policy, and it's going to specifically talk about that and what the coverage is. But because there's so much nuance to it, and because it does seem to have a level of subjectivity to it, a little bit of knowledge can go a long way, and a little bit of conversation can go a long way. And again, this is not something as simple as, cut and dry, like I had this item and now it's stolen, and it's pretty binary. Smoke damage, at least right now, is a little more complicated than that. All right. I was going to go on to this next question, but I don't want to rush it because it's a really good one and an important one. So we're going to take our next break. Remember, if you have questions, send them in to me at questions@insurancehour.com. You can also call or text directly to 559-656-0317. I will get back to you either way. And if it's an email question, I'll either email you right back or I'll read it on the show during one of these summary shows where we go through all of the questions and answers. If you don't want your question read, please do let me know. I will do my best to never call anybody out by name anyway, so that's not an issue. But again, if you don't want your question read out loud, then just let me know. 60 seconds and we will be back. This is Insurance Hour. I am your host, Karl Susman. Stand by. We will be back in a flash.
What if your insurance failed you tomorrow? A wildfire, a burst pipe, a car accident. Most people think they're covered until they find out they're not. And that's exactly why the Insurance Consumer Guidance Society, ICGS, exists. We are an independent nonprofit organization helping Californians understand their insurance before disaster strikes. No sales pitch, no corporate agenda, just clear, unbiased guidance from licensed experts who work for you, not the insurance companies. Whether you're a homeowner, renter, or a business owner, ICGS helps you navigate premiums, exclusions, deductibles, even California's complex wildfire and hazard requirements. Because the biggest risk isn't the disaster itself. It's not knowing what your policy actually covers. Visit icgs.org to get free education and support. And because ICGS is a nonprofit, your donation helps keep this vital service free for Californians who need it most. ICGS, empowering Californians to make informed insurance decisions.
Hello. This is Insurance Hour with me, your host, Karl Susman. Thank you so much for being here today. We are talking about my favorite topic and yours, insurance. Before I go on, I want to make a quick point. Insurance is one of those things that is fairly dynamic, meaning it does change. Something that might be very simple and straightforward today may not be tomorrow. And I do the best I can to get you the most up-to-date and the most accurate information that I can. But I'm only human, I know, hard to imagine, and sometimes I just don't get it right. So if you hear something and it just seems wrong to you, or you've heard different than what I'm telling you, then please let me know, because my goal is to get the correct information out to you. It's not about me knowing more. So if you hear something, say something. Give me a call, 559-656-0317. Text that number. Shoot me an email to questions@insurancehour.com. Do not be shy. If I screw something up and you point it out, I will be sure to correct it on the next show, because again, the goal is to get the right information out to people, right? So again, I do the best I can, not always perfect, but I am always looking for corrections if there are any. Don't be shy. Feel free to let me know. All right, next question, and this is a big one I want to go over. It's saying my insurer is offering actual cash value on my roof because it's old. Can they do that when my policy says replacement cost? I want to know my options before I accept anything. Now, there's a few nuance to this. So if I read this in parts, the first thing, my insurer is offering actual cash value on my roof. Now, before I go any further, I would immediately stop and say, well, let's look at the insurance policy. Does it say that the roof is going to be paid on an actual cash value basis? Then I'll continue reading and it says, because it's old. Then I would stop again and I would say, okay, well, are they saying that they're going to pay actual cash value on your roof because it's old? And if so, as you're claiming, is that in the policy? And then we read on and it says, can they do that if my policy says replacement cost? Well, again, you got to look at the policy because we're going in a few different directions here. I would suspect that if they are offering you actual cash value on your roof, it's because it's in the policy, and it says that they're going to pay actual cash value for a roof that's over a certain number of years old. That's what I would presume to be the case. Now, you're saying the policy says replacement cost. Now, the policy might be a replacement cost policy. However, and this is where it gets interesting, you need to read your policy to see what is covered under replacement cost. For example, is it the house? What about personal property? What about the roof? What about specific items that you might have? Jewelry, watches, furs, cash, securities, guns, things like that. Are these things all going to be without limit at whatever the replacement cost is? Chances are there are going to be limits, and there are going to be different ways that they determine what they're going to pay on it, whether it be replacement cost, actual cash value. There's even something called functional replacement cost. Functional replacement cost says, okay, we're going to rebuild, but we're not going to put in all the fancy schmancy stuff. We're just going to put in something that will work, in essence. So instead of the granite countertop and the marble floors, you're just going to get a countertop and floors. Now, as you can imagine, this is not what most people want. So you want to be on the lookout. If you have a policy that says functional replacement cost, be sure you know now what that means and know to ask, is there a way I can either pay more and have a straight replacement cost policy? But again, not to get off on that tangent, but I wanted to make the point clear. You got to reference your policy. So I would say that if you are being offered actual cash value for an old roof, I would say there's probably something in your policy that references it. If it turns out that there is nothing anywhere in your insurance policy that talks about actual cash value for your roof based on age, and the policy otherwise says replacement cost, most likely in a vacuum of all other information, I would say that it's probably a mistake and that you should be looking to get replacement cost. But again, we would need to reference the policy to find out. The policy is always your friend. That's where it goes. A lot of times people get frustrated when it's claim time and they don't like how things are coming out. We see this happening. I mean, it's just the law of numbers, right? And like I said earlier, just because we want something to be covered doesn't make it so. But all we have to do is look at the insurance policy to see what is going to be covered and what is not. And it's always better to check it before there's a loss than to check it after and then be upset, because it might be a matter of making some changes to the policy to make it look a little bit more like you would prefer it to be, versus just hoping, assuming, not thinking about it twice, and then there's a loss and something happens. Let's get on to the next one. I live in a condominium/condo. I guess that's the same thing. Do I need a condo policy, or does my HOA already pay for it? All right, this is a good one. So condominium policies are definitely things you want to have. Now, your HOA, your homeowners association policy, is going to, and again, I'm going to give you a general take because some of them can be a little bit different. But for the most part, HOA policies are designed, built, whatever the case may be, to put the structure back together. Now, you are one unit in that building. So most policies will simply give you that one unit, and that's it, and nothing inside. So you'll have your four walls, your floor, your roof. That's it. It's going to be up to you and a condominium owner policy, which is also known usually as an HO6 policy form, that's going to pay for everything inside your unit. Now, that could be everything inside your unit, from the floor, carpet, hardwood, whatever you might have, to the walls, breaking up the different rooms in your condo. Yes, it is entirely possible. I have seen it where a condominium the HOA policy will seriously just give you four walls, a roof, and a floor. And it's up to your HO6 policy to pay for everything else. Even the more generous policies, maybe they will build out the frame, the bedrooms, and walls within your house, your condominium, but they're not going to pay for the fixtures. They're not going to pay for your personal property ever. So your stuff will never be covered. That's definitely something you need to have a condominium owner's policy for. And condominium owner's policies give you lots of other things that you want, like personal liability. That's that minor detail, that thing that will protect you in the event of a negligent lawsuit. Things like that you want to be sure that you have. So yes, and this is a big one I wish people knew more. Just because you're owning a property that has a homeowners association, that does not mean that all of the complex insurance parts that you would need to have protection for are covered for you. They are not. Let me say it again. Just because you have a policy, you have a home that's in a condominium complex, it does not mean you have all of the insurance policy coverages that you need to have. More on that later. Let's take a quick break. Insurance Hour. Karl Susman, that is I, and this is the show. Talk to you in a few.
Has this happened to you? You ask 3 different people about insurance and get 3 completely different answers. Your neighbor says one thing, your agent says another, and the internet, a total mess. No wonder so many Californians are confused about what their policies actually cover. That's why the Insurance Consumer Guidance Society exists. ICGS is a nonprofit independent resource created to help you cut through the noise and understand your insurance options with confidence. Their licensed experts don't work for insurance companies. They work for you. They'll walk you through premiums, exclusions, wildfire requirements, and more. Even help you make sense of those long renewal notices that feel designed to overwhelm you. So whether you're a homeowner, a renter, or caring for a property in a high-risk area, ICGS gives you the clarity you deserve. Visit icgs.org for free unbiased guidance. Please consider supporting ICGS with a donation. Your generosity keeps this service accessible to Californians who need it the most. ICGS, here for you.
Hello. This is Insurance Hour with me, your host, Karl Susman. How are you doing? If you're just joining us, we are talking about all things insurance today. We're actually going through and we are reading questions that you have submitted, and I'm giving you the answers to the best of my ability. Before I go on again, I want to thank our sponsor, the Insurance Consumer Guidance Society, ICGS. They are the ones that are footing the bill for you to be able to be learning all of this information. We could not be doing this without them. We need their help. And guess what? They need your help. Visit icgs.org. Find out about what they're doing. And you know what? Kick over a few bucks. If you're enjoying this show, if you're learning something, you know what? These things are not inexpensive or trivial to make happen. To get this information out to you is not easy, and it does not come cheap. Please visit icgs.org. See if you can contribute a little bit. Let's go ahead and continue on today. But remember, thank our friends over at the Insurance Consumer Guidance Society. All right, we are talking about your questions and my answers. So let's go to the next question here. We have someone drove into my fence and took it off. It's a funny way of putting it. Took it off. Is that a homeowner's claim or an auto claim? Oh, that's a great question. All right. The answer is going to be, it depends on who's filing the claim. So someone just drove into your fence and damaged it, let's just say. Took it off just sounds bizarre to me. Like, what did they drive into it, grab it and run away? Or just knock it down? Or what happened? So the person that drove into your fence, now, again, we're going to look at this in a vacuum and just assume the simple and the obvious, which is that, hey, you know what? They were at fault. Nothing unusual happened and they smashed into your fence. They can file their claim under their auto insurance policy for property damage, and hopefully that will cover your damage to your fence. In the absence of that, and unfortunately, when these types of things happen, sometimes people don't just, what's the nice way of putting this? They don't always fess up to it, meaning they might have hit the fence and just disappeared. Meaning you're stuck with a broken fence. So if you wanted to file a claim, you would file that under your homeowner's insurance policy. Now, let's take that one step further. In the event that they do the right thing and they at least contact you, or you know who they are, you have their license plate, something like that happens, then what you can do is potentially file the claim on your homeowner's policy, get the damage repaired and replaced, and then your insurance company will do what's called subrogate, meaning they will turn around and go back to the responsible party to try and get the money back. Now, this benefits you because if your insurance company is not paying out on a claim, then that's going to impact your ability to have discounts and premium changes in the future. So remember, if your insurance company is paying something on a claim, that's going to come back to haunt you at some point if it's not something that they can recover elsewhere. So do the best you can to try and provide them with whatever information you can to be able to get that money back. You might notice this with health insurance companies as well. I remember one time I went, I wish it was only one time. I went and had an x-ray or something done. And I don't know, a couple of weeks later, I had this letter that came from the health insurance carrier, and it says, "We see you had this x-ray. Was this the result of an accident? Did something happen? Is there another responsible party?" And I was thinking, what the heck's the difference? I'm paying you. You're my health insurance company. Pay the darn bill. And they did. But the reason they were asking is because they're saying to themselves, well, you know what? If he was in an accident and somebody else caused him to need to have this x-ray done, then we, meaning the insurance company, can go back to that responsible party and collect our money. That is a good thing. Turns out it wasn't the case, but it's the same idea. Subrogation is a large part of how insurance works, and it happens in the background a lot of times. Let me give you another example that's not exactly subrogation, but it's something that you're probably hearing a lot about. Again, when we're talking about the fires from 2025, we're talking about responsible parties, right? Who's responsible? Now, the Altadena fire, they are saying for the most part is going to be a utility company liability. So the insurance companies are paying for the damage to the homes. And then based on laws and regulations, they're allowed to go back and collect a portion of what they paid out from the responsible party, which in this case looks like it's going to be the utility company. Now, for some reason, they're not able to collect all of it. I'm not quite sure why that is. There's some laws that have changed recently that give them a maximum recovery percentage. Again, in my mind, if there's a responsible party, you should be able to collect your money, period, mic drop. But, what do I know? So that's a form of subrogation. That's a form of the insurance carrier being able to go back and recoup money that it paid because it was the responsibility of another party. Now, of course, it's kind of funny because you know that the utility company has its own insurance. And so it's one insurance company paying another insurance company and moving the money around. Interestingly enough, I was talking with someone about this not too long ago, and they were saying, well, if the utility company has to pay all this money because of the damage that was caused because of their power lines, aren't they just going to raise the rates on the utility? Yeah, the answer is yes, they will. At the end of the day, there really is no free ride. And when large-scale losses happen, just like when small losses happen, somebody has to pay for it. Money has to come from somewhere. And as much as we don't like it, and it irks us and peeves us and everything else, insert your expletive here, this is what happens when there is a loss. When someone loses something, there's damage, there's a loss of money, then that's going to impact somebody somewhere, whether it's an insurance company or another insurance company or an individual that doesn't have insurance. Some exchange of monetary value is going to happen when there's a loss if there's a responsible party. It's just the way the world works. So that's the long answer to the guy or girl who took off your fence. All right. Next question is, I'm thinking about raising my auto deductible to lower premium. When is it worth it? Okay, car insurance is a funny thing too, because we want it to be as inexpensive as we can, but at the same time, if we get the slightest damage to our car, especially us in California, we want to immediately have that tiny little scratch or ding fixed. And then we get annoyed because it costs money and there's a deductible and then our rate can go up. So this is my philosophy on auto insurance. You should carry a deductible that's as high as you can comfortably cover in the event of a loss, because auto insurance is not there to fix the little scratches and the little dings. You're just going to end up paying for it in the long run or the short run anyway. So again, it's a cultural shift. We have to start looking at insurance as being something for the large events, the large car accidents, the major damage, the theft of vehicles, things like that, versus a little pebble popped up and now I've got this teeny little scratch on my bumper. Don't think about putting those claims in. And so, yes, I absolutely love higher deductibles on car insurance. It saves money for you now and in the long term. One more segment to go. 60-second break. Karl Susman and Insurance Hour. Stand by.
Have you ever opened a letter from your insurance company and felt your stomach drop? A canceled policy, a sudden premium spike, a long list of terms no one speaks in real life. Most Californians don't realize how fast their insurance situation can change until it already has. That's where the Insurance Consumer Guidance Society steps in. ICGS is an independent, nonprofit organization that helps you understand what's really going on with your coverage before it becomes a crisis. No sales tactics, no company agenda, just licensed experts who explain your options in plain English. From homeowners and renters insurance to wildfire zones, hazard requirements, and everything in between. So the next time a letter arrives and you feel that jolt of panic, you don't have to face it alone. Visit icgs.org to get clear, reliable guidance you can trust. And because ICGS is a nonprofit, your donation helps keep this vital service free for Californians who need it the most. ICGS, always by your side.
Hello. This is Insurance Hour with me, your host, Karl Susman. Thank you so much for being here today and learning about insurance. Hopefully this is going to be something that will save you frustration and money in the long term. Insurance is not always the most intuitive thing. There are the right answers and the wrong answers to a lot of things, and definitely knowledge is power. Before I go on, I want to thank once again the Insurance Consumer Guidance Society, ICGS, for their support. We would not be able to put this show out without them. They are the ones paying for the airtime, for the post-production, for all of that stuff. If you are finding this useful, please think about going to icgs.org, toss a few bucks over. They really could use it, and we want to keep this show fresh and live and up to date, and we cannot do it without your help. Appreciate ICGS, the Insurance Consumer Guidance Society, everything that they do to help us stay up to date with our insurance. All right, in our final segment here, let's see if we can burn through some more of these questions before we are done. Let's see the next one. My teenage son is about to get his license and I'm bracing for the rate increase. What are the best ways to keep premiums down on new drivers? Well, just don't let them drive. Hey, ta-da! Exclude them. Then no problem. Tell them to take an Uber or a Waymo. Kidding. But have you noticed that when we were growing up, we used to be waiting in line when the time came to be able to get our driver's license? I mean, we were counting the minutes and the hours to get our permits and then to get our licenses. And somehow now, people don't do that. They'll get, kids will get it when they're 17, maybe even 18. They're not in so much of a rush as they used to be. It's kind of strange. But at some point, you will be in a situation where you have a young driver, a new driver. And yes, because in California, one of the main factors that are at play when it comes to determining the price for your car insurance is the number of years of driving experience. Well, when you're starting off with zero, guess what? It is going to cost you more. It's an interesting little scale because it starts out really expensive when you have no experience. And then when you get older, what's the PC way of saying really, really, really old? All right, inside joke to Grubba out there. With your GDS, Grubba, remember that? GDS. All right, anyway, if you get to a stage where you are extremely old, and yes, you might say, well, look, I've got tons and tons and tons of years of driving experience. There is a point of diminishing returns. So you will be at a place where it does start costing more, even though your level of experience and years driving is higher. So there is that point. But anyway, for a new driver, here are some things that you can do. Number one, make sure that they take all of the driver training courses that are available. Now, there are some you can take online, and there are some that you have to take in person. Now, I'm not talking about what the state requires for you to get your license. Obviously, you're going to do that. But there are other things you can do that some insurance companies will provide discounts for. Another thing you can do is look for additional new driver discounts. There are good student discounts that are out there. Okay, so if your student has grades that are, again, it depends on the insurance company. Some want an A average, some want a B average. It just depends. But definitely check and see, because there are discounts that are available for new drivers and not for other drivers. And a good student is one, driver training is another. There's nothing that is going to really hurt, that's really going to stop the burn like you probably would like it to be. Because again, statistically speaking, newer drivers tend to have more accidents than more experienced drivers. So the rate is going to show that. Believe me, in California, The insurance market is heavily regulated. If they did not have hard numbers to be able to show that is the case, then I promise you, you would not be paying more for new drivers. You are, because they do tend to have more accidents. Whether they be big or small, it happens. Now, some people will say, well, should I just get a cheap car for them? That will certainly help. However, keep in mind that most insurance policies will do what's called highest rated driver, meaning if you have a very expensive car and you give your your new driver a less expensive car, since the insurance company is not able to exclude them from coverage if they do drive your expensive car, they're going to charge premium as if they can drive that car. Even if you swear up and down, they will never drive my car, no way, no how, because they can't remove that as an option of coverage. You might still end up paying premium for it. So sure, a less expensive car will help, but the days of being able to say, well, I'm going to buy them this old junker, they're never going to touch my Tesla. And unfortunately, you're going to still be paying as if they can touch your Tesla, because as far as the policies are concerned, they can. All right, I think we have time for one more. Let's jump in here. If I lend my car to a friend and they cause an accident, whose insurance pays first? Okay, it's a great question. Now, insurance follows, the vehicle before the driver. So in this case, if you lend your car to someone and they have an accident, and let's just say they caused it, your insurance company is the one that's going to pay first, meaning they are primary because you are the registered owner of the vehicle and the insurance policy follows the vehicle first. Now, again, go back and listen to subrogation. We talked about it today. No question that your insurance company is going to turn around and try and subrogate against the driver's insurance policy. But as far as claim processes and the order of operations, insurance follows the vehicle as primary. That is, believe it or not, going to do it. I cannot believe how time flies. When we do these question and answer shows, there is just so much information we get out there. Thank you so much for listening. Remember, please visit our sponsor at icgs.org. See if you can help. See if you can contribute. Let's keep these shows live and up to date. Once again, I am Karl Susman. This has been Insurance Hour. Stay safe, and we'll talk again soon. I do want to thank all of you for taking the time to listen today. I know insurance is not necessarily the most sexy concept. It is important that you understand what it is you're looking for, what it is you think you're getting, and finally, what you actually did purchase. You simply need to know more than you used to. Things are more complicated. If you have any questions, please reach out to me directly at 559-656-0317. You may also send your questions to questions@insurancehour.com. Informing, educating, and entertaining, one policy at a time. This is Insurance Hour. The show is dedicated to Shamrock Papa.